Hello everyone, and welcome back to the Quant Lab. Over the course of Chapter 3, we have completely deconstructed the absolute architecture of the market. We built horizontal dense trading zones. We mapped the diagonal velocity of trend lines. We measured the massive capital footprints of key K-lines, and we exploit the frictionless vacuum of price gaps. But I must give you a critical warning. Treating these tools in isolation is extremely dangerous. A 20-day moving average floating in empty space is weak. A minor trend line floating in empty space is weak. The ultimate quantitative edge is achieved only through confluence, the mathematical overlapping of multiple independent structural boundaries. Today, we are going to synthesize everything we have learned into a single two-step execution matrix. This is the exact master support and resistance framework I use to process charts for my weekly stock analysis videos. Before we build our matrix, we must establish the hierarchy of market analysis. Quantitative trading requires a perfect alignment of both market catalysis and structural precision. Catalysis dictate what to trade. For long-term investments, macroeconomic fundamentals and corporate earnings models dictate the asset's underlying value. But for high beta and momentum assets, the catalyst is often pure sentiment or liquidity flows. However, structure dictates when and where to execute. A catalyst cannot time the market. A fundamentally brilliant company bought at the absolute peak of an exhaustion gap will result in a severe drawdown. You use your catalyst to curate a premium watch list, and you use the structural matrix to snap the entry. To eliminate human emotion, quantitative traders process their charts using a strict two-step logical flow. Step 1 is pure data collection. Let's look at a theoretical high beta stock currently trading at 228. This is a fake example. We systematically scan the chart and catalog every active boundary into a master logs. To maintain absolute organization, we split this into two distinct tables based on our current execution price. One for overhead supply, or the resistance, and one for underlying demand, or support. We chunk the data by structural tool, dense zooms, moving averages, gaps, Ichimoku, Fibonacci, and trend lines. We record the specific price band, and we assign a density weight, weak, medium, strong, or very strong. Even if a tool is not currently present near the price action, we list it in our template to ensure our systemic audit is complete. Once the raw data is cataloged, we proceed to step 2, synthesis. We scan our massive raw data tables and look for mathematical overlaps. Notice how we have structured our final confluence summary matrix. We placed the price band in the very first column. By doing this, the table transfers into a vertical spatial map. As you scan down the table, your eyes naturally move from the highest resistance down to the current execution price of 228 and down to the lowest support floor. Let's look at word support extraction. Notice how the consolidation box at 215 right here, right here, 215 to $218. The breakaway gap at 215 at the 38.2 Fibonacci line at 216. The 120 period MA moving average and the primary uptrend all cluster together in the raw data. 5 independent structural tools converge within a tight 2% price band. This creates an algorithmic fortress. We extract this massive cluster and place it into our summary matrix as our sniper entry zone right here. We also extract the absolute origin swing low at $195 to $200. This gives us a strict, definitive macro invalidation floor or hard stop. We do the exact same thing for resistance. We extract the cluster of the 60 period MA exhaustion gap and 61.8% Fibonacci to create our primary target at 232 to 234. We merge the 200 period MA and the secondary downtrend to form our secondary target to 230 at 236 to $238.5. And finally, the macro distribution based and Ichimoku cloud formed or absolute macro target ceiling at 240 to $242.5. All of these tables and their text code I have made it available in Appendix A4. Okay, so here are the tables and the LaTeX code. Okay, let's get back to the lecture. So this Confluence Summary Matrix is your final emotionless trade plan. You scale your capital heavily into these overlapping zones, placing a strict hard stop loss directly below the absolute lowest structural boundary in that cluster, ensuring maximum mathematical asymmetry. But there is one piece of puzzle missing. The structural matrix perfectly maps the overarching macroeconomic zones of support and resistance. But once the price pushes back and physically enter war, for example, 214 to 218 sniper zone, how do we know exactly which day or which hour the algorithms have finally finished their liquidity sweep and are reversing the price? The absolute final step for execution timing relies on macro structure, specifically the extreme wicks and shapes of individual candlesticks. The shapes of localized special K-lines serves as our immediate trading triggers to fire the bullet inside the macro zone. In Chapter 4, we will master these macro formations. For example, the hammer, the shooting stars. I will see you in the next chapter.